And now for something completely different.
Forget everything you've been told by others before. Get ready for the real deal, the full story. Real talk about money, markets, life. Now, it's The Real Investment Show with Lance Roberts, presented by RIA Advisors.
Live Q&A. If you have questions you want to ask, Leah has been gracious enough to come in this morning and monitor through your chat and try to pick out questions, and I'll be more than happy to answer those for you. Just doing something a little bit different, just to, instead of just me rambling up here every day, actually answer questions that are important to you. So do I think the 4% rule and the classic 60-40 split in retirement still makes sense in today's world? Look, there is no perfect allocation for anybody. Historically speaking, going back 130 years, the 60-40 allocation has beat, hands down, every other asset model, being 100% long equities or anything else, because it reduces volatility, creates income, and creates total return for portfolios, which works to your benefit over time. So again, the allocation model is about reducing beta volatility. That's why you own bonds. So in any portfolio, your goal is to have all three legs of the stool in place, which is capital appreciation, dividends from stock, and incomes from bonds. The benefit that bonds give you in that allocation is guarantee of principal. Now, again, we're not talking about owning bond ETFs. So when you're talking about the 60-40 allocation, if you're buying bond ETFs, you are eliminating the one reason to own bonds, which is guarantee of principal. Because at maturity, those bonds come back to you at full face value, regardless of if I own a portfolio of 60-40 bonds and interest rates go to the moon, which is everybody's fear, the principal side of my bond allocation will go down in price while I'm still collecting the yield on those bonds. So I'm still collecting the income. So if we've talked about before on the show, if I just break a portfolio in half, right, and say 50% stocks, 50% bonds, and I put 50% of my bonds into 10-year U.S. Treasuries that are paying 4%. And if my goal is every year to generate a 6% rate of return, well, immediately I've already got 2 of that 6% just coming in from the income from the bonds. 50% of 4% is 2%. If my portfolio has a dividend yield of 2%, S&P yield, then I've got another percent coming in from dividends. So already, just by building that portfolio, January the 1st, I already know that I've got 3 of my 6% already intact. Now, if interest rates go to the moon, I'm still getting my 4%. Yes, the bond value side of my portfolio will go down in price because interest rates have gone up. But as those bonds mature, I get all my money back. I don't have to worry about that side of my portfolio. So why would I not want to own a 60-40 allocation? Now, there's been a lot of conversation in recent weeks. In fact, I wrote an article about this. Jeff Gundlach and BlackRock had come out and said, you should put Bitcoin. Instead of 60-40 bonds, stocks, and bonds, you should have 60% stocks and say 20% bonds, 10% Bitcoin, and 10% gold. Okay, that's fine. Except gold gives me no guarantee of principal. It also gives me no income. So let's go back to our theoretical model, right? So now I've got 50-50 in my portfolio. Let's say that I put 25% in bonds and 25% in gold, just easy math. Well, I just turned my income, my guaranteed income stream that I was going to generate to make my 6% rate of return, I've now cut 1% off of that because I've reduced the amount of bonds that I own in my portfolio. So I've cut my income because gold doesn't pay an income. Now, I'm hoping that the price of gold goes up, but there have been very long periods of time where gold hasn't done that. So again, I'm impacting the one side of my portfolio. The reason that I own the bonds in my portfolio is to lower the volatility of my portfolio. So now I put a volatile asset of gold in my safety bucket, right? And if it doesn't go up, I've got more volatility. So I've increased the volatility run of my portfolio overall, which weighs on my emotional bias as I'm going through life. But then I also decrease my guaranteed income stream. So now my 6% is more dependent upon volatility rather than guarantee of income, which is, again, it just depends on what you want. But now let's slap some Bitcoin in there as well. And now not only have I massively increased the volatility of my portfolio by adding Bitcoin to it, I still have reduced the guaranteed income stream. I've also reduced the guarantee of my principal being repaid to me in the future. So again, how you approach, so again, I'm not debating whether or not you should own a 60-40 or not. That's really a personal choice. I'm just saying that we have to understand why the 60-40 allocation has been so successful over the last 130 years. And why it's beaten every other asset class hands down is because in rising interest rate environments and falling interest rates environments, it is outperformed over time. Over time. The key word is over time. Not over the course of a year, not over the course of 3 years. We're talking about over the course of 100 years, right? We're talking about over the course of 20-year spans. We're talking about over the course of 30-year spans. Your investable lifetime, 60-40 has done better because of one reason and one reason only. It reduces volatility. So your drawdowns are less, which means that when markets start gaining ground again, you don't have as much to make up on the loss side. So again, whether it's 60-40, 70-30, 80-20, the important thing to remember is that whatever allocation that you want to capital preservation, that should be in bonds. Very safe bonds, right? AAA, AA, single A, triple B corporates, stay away from junk. Because once you get into junk bonds, that's basically a risk asset. So you just think about start just thinking about your portfolio as a function of safe money, a safe money bucket that's going to be there regardless of what happens, and your risk bucket. So gold, Bitcoin, stocks, emerging markets, private equities, private credit, high yield bonds. That's all in your risk bucket. So when you're thinking about your allocation and how you want to set it up for yourself, think about your portfolio as two buckets. One, my risk bucket. That's if everything goes great, I'm in great shape. But also consider what happens to your risk bucket if everything goes wrong. Because can you recover from that? And in that moment, when you have that risk bucket go wrong, which it does from time to time, you'll be glad you had the safe bucket. So again, just something to think about. All right, good morning and welcome back to the show. Of course, Danny Ratliff joined me this morning. Danny, how are you, sir?
Hello, good morning. Doing great.
Getting ready for the Christmas holidays?
The best we can.
Santa Claus is almost here.
Santa is almost here.
So, yeah, we told our kids growing up the day they stopped believing in Santa Claus is Santa Claus stops coming. So
well,
that worked great. They lied for years.
We are there now. My oldest is like, my middle one's the one who's giving us a bunch of grief, and he is letting everybody else know. And the oldest is like, "What are you doing?" And she won't say why, but I think she knows because she knows. Hey, that Santa train stops quick.
Yeah. Well, no, the problem is you have to deal with people at school, right? So. Yeah. It makes it tough.
No, for sure.
All right. Well, let's get into some questions this morning, Danny. What we got working on?
Got a lot of good questions, and so kind of jumping around a little bit. But obviously, big day today, the Fed meeting. So one of the questions was: has the Fed given up on its inflation mandate?
Yes. Yes. They won't say that openly, right? But they're supposed to be their target. They're supposed to only have two mandates, which are basically inflation expectations, keeping price stability, and full employment. And we've seen more of a shift to that really since 2008. Even though they continue to say that their mandate is price stability and inflation, their real mandate is creating the wealth effect. Yeah. And what they figured out after 2009, and we've stated this before on the show, so this won't be new if you've been watching the show for a while. Ben Bernanke back in 2010 specifically said in a speech, he says the reason we do QE is to raise asset prices to boost the wealth effect, which helps economic growth. So this is why you see, despite the fact that if you're concerned about inflationary pressures, et cetera, they're not really focused on that. They're focused on making sure that the financial system is operating functionally. Again, we've just talked recently about the lack of liquidity. The Fed now has stopped QT and has restarted they have not started QE, right? So let's just say that they have not started QE, but they will purchase about $45 billion worth of bonds this month. As mortgages roll off their balance sheet, they've got to keep their balance sheet stable. So there's going to be a lot more activity and of providing liquidity to the markets. So when they provide liquidity, and this is what we talked about before, the Fed does not print money. So let's just solve that problem right there. They create reserves, and those reserves get lent to whom? Hedge funds, pension funds, insurance companies, et cetera. So anybody that can access the overnight window, that's where those reserves come into play, creates leverage for the markets, and so that's how liquidity gets itself back into the markets and why the banks are looking for more assistance from the Fed.
So obviously today, being that we're going to get a lot of information, do you anticipate a sell-off like we've been seeing last several times, or
who knows? It just like I said before the wrap, it just really depends on
forward guidance, from Powell?
It really does. It really depends on what Powell says. If Powell comes out very hawkish, and look, he's about to lose his seat, so it looks like right now that Kevin Hassett is odds-on winner that he'll take the place of Jerome Powell next year. So Jerome Powell is not a fan of President Trump. I don't think, at least from past comments, he doesn't seem to be a fan of President Trump and the policies. So, him coming out today and saying, hey, you know what, we're going to just, put a pause on rate hikes, whatever. Again, anything that leans more hawkish is going to potentially have a negative impact to the market. So, yes, I would expect either late today or tomorrow for there to be a pickup in volatility in the markets. And we're already seeing that. The VIX has been rising for the last 3 days, as I was just showing you a second ago. So, yeah, I would definitely expect that. There was a question. There was a question here, real quick. I've lost it now. Go get. Okay, go ahead. Keep going. Oh, that is why I mind explaining what 3 standard deviations are. We've written some articles. If you go to our website and type in Bollinger Bands in the search bar, you'll also find articles we've written about standard deviations and importance of that. But when you think about standard deviations, we're talking about a normalized bell curve, and you'll see these kind of graphics a lot. When we talk about risk, you have tail risk on one end, tail risk on the other, and then most of your activity happens in the middle of this bell curve, right? So if you just think about a normal bell curve, the vast majority of your outcomes are going to occur within that kind of that middle part of the bell. That's where everything occurs. So when you look at standard deviations, if you split that bell curve right down the middle, that's positive and negative. From that center point, you have positive and negative. So about 95% of all activity is going to occur within what's called 2 standard deviations. So it's 1 standard deviation on each side of that bell curve. So within that 2 standard deviation range, that's about 95% of action. 3 standard deviations encompasses about 99% of all that action. Once you get to 4 standard deviations, you're at 99.999%. 5 standard deviations, you're 99.99999. But I mean, just, you're talking about once you get to 3 and 4 standard deviations, you're starting to get out on the edges of that bell curve, right? And that's what we call tail risk. So if you just think about stretching a rubber band in one direction, if you stretch a rubber band and where it gets kind of taut, and that's where it's like starting to get kind of hard to pull it, then that's 2 standard deviations. 3 standard deviations is now you're really starting to stretch it, right? I mean, you're starting to maybe see some cracks in the band. That's the stretch of 3 standard deviations. So that's why it's important when we talk about, things are moving 2 and 3 standard deviations away from their means. That's why you eventually always get those corrections. So again, there was a comment about silver a second ago. Silver's trading 4.5 standard deviations above its long-term mean, right? It's had these kind of spikes historically before. It always crashes after these types of spikes because it just can't sustain that type of move price-wise for very long. So if any sellers show up, you're going to get a very, very sharp reversal in the price of silver at some point. Again, it's great right now. We were talking about this earlier. It's great right now because it's going up. So if you're long silver, you're making money like crazy. Don't forget to take some profits along the way because you've stretched that rubber band now you're even more than where the rubber band's starting to show some cracks. You're way out there. So eventually that rubber band is going to snap back. And if you just go look at a long-term chart of silver, you'll see these spikes historically. They always correct 70, 80% of those spikes. So just, again, that's why it's important to pay attention to these technical deviations, because they always result in a reversion. Not if, not maybe, always result in a reversion at some point. And again, that's the big thing, a reversion at some point. It doesn't mean tomorrow, doesn't mean next week, could be next month, next quarter, but it always results in a reversion at some point. So good question, though.
Yeah, no, really good question. So while you're on that type of, we're on that vein here. So trying to get smarter on money flows, leverage, credit risk, and liquidity in public and private markets. What indicators, data should I look at and track to help get smarter on this? This is a good one. There's so much.
Well, the problem is there's not one for any of these, right? I mean, this is why we pay for data sets we have massive data sets that we can draw on. But, to look at money flows, you need to look at money flows, right? So, how much money is flowing into or out of ETFs as a whole? How much money is flowing into or out of mutual funds as a whole? You can get you can get some of that data from ICI.com, which is they track all the money flows into ETFs and mutual funds. In terms of credit risk, you take a look at leverage, you look at margin debt, you look at the amount of levered ETFs that are trading in the open market, how much AUM is in those levered ETFs. Take a look at credit spreads, particularly, your investment grade bonds to your junk related bonds, and take a watch on credit spreads. That's why, on SimpleVisor, we track credit spreads on SimpleVisor just for that reason. And, liquidity in the public and private markets, you can't really track that too much because it's private. But what you can look at is how much money is in AUM of private equity funds, private credit funds. That data is out there. But again, this is, stuff you're just going to have to hunt to try to get a hold of that data. There's not just go watch this one indicator. It tells you everything you need to know. I mean, this is why Mike and I spend, our entire day just monitoring, data sets, writing articles, doing other type of stuff. And we write articles about this stuff all the time. So again, if you want to keep up with what's going on this stuff, read our weekly newsletter, go to our website, read our blog. You can subscribe. We'll email them to you as we produce them. But we're constantly writing about this stuff and putting it out there for you so that you can kind of keep up with what's happening in the overall market. So again, it's a good question, but it's not, this is something that is not that's not a simple solution to that question. There's so much data out there that is available. You just got to go find it, or most likely you're going to have to pay for it because it's not free.
Real Investment Show podcasts are now available on iTunes. Listen anyplace, anytime at iTunes.com.
What's the future of investing in 2026? Gain insights on how AI, technology, and the economy will shape your money in the year ahead at the RIA Economics Summit, January 17th at the Royal Sonesta Houston Galleria. Join Lance Roberts, Michael Leibowitz, and Thoughtful Money's Adam Taggart, plus top minds in AI, crypto, and retirement strategy for a powerful look at the markets of tomorrow. Seats are limited. Register now at realinvestmentadvice.com. realinvestmentadvice.com.
You're listening to The Real Investment Show.
A couple of people mentioned that inflation, kind of disagree with that analysis on inflation in the sense that tariffs are not necessarily causing inflation in the sense of that the consumer's paying for it, that the producer's actually eating that cost at the moment. And I think one big thing to think about is that we're going back to when were tariffs enacted, the beginning of this year.
Right.
And most of that cost that you're seeing right now that you're paying when you go to the grocery store, everywhere else that you go, that's already been done. And a big portion of that was because of what has essentially happened during COVID, all the stimulus, all the things that occurred during that time. And what we're seeing the delta, the change in it is going up much slower. So what you're really talking about, we're talking about disinflation versus deflation. And we really don't want that deflationary aspect because inevitably that means that you're going to the store and paying less, which means we're going to be in an economic turmoil, a time of, where everybody's lots of people are looking for jobs. It's not a great scenario. And so I get it. I understand your sentiment. Everybody feels it. But the tariffs, if we look at that, if what was PCE was 2.8, what are the other numbers? Were all relatively in line, and nothing that has been shocking to the upside where it's like, whoa, okay, we've seen massive increase in inflation because of tariffs. All that stuff's been baked in.
Well, no, and the other side is that, people are mistaking two things. One, what's the source of inflation? Mm-hmm. And two, what's causing inflation? And there's two different things. Look, yes, prices are going up. They will always go up because we have economic growth. And as economic growth goes up, you're going to the store, you're buying stuff, you're creating demand. So every time you go to the store and you buy food, right? If you're buying, if food sales are going higher, corporations are going to go, I'm going to charge a little bit more because I just sold out of everything I had at $2 a dozen for eggs. I'm just picking a number. So I'm going to charge $2.05 next time. Right. And so you'll pay that. And then they'll say, okay, we sold out of everything there, so we're still good. We'll go to $2.10. And so prices go up. But that's economic growth. So as your wage growth goes up, as economic growth goes up, you're going to get inflation. If you're not getting inflation, this is why the Fed wants 2% inflation. You have to have inflation to have economic growth. If you don't have inflation, if you don't have prices going up, you don't have economic growth. And if you don't have economic growth, you're not getting wages. You're not getting, better lifestyle. Your wealth won't be growing. So yes, inflation is a byproduct of, and it's a result of your growth in the economy, your increase in wealth, your economic prosperity is all reflected by what's happening with inflation. What you don't want are big spikes of inflation that are above the rate of economic growth. That's what the Fed doesn't want. So now you've got some type of esoteric force that's now weighing on the economy and creating inflation spikes, i.e. the oil embargo, right? Back in the 70s when we had that big inflation spike, oil was shut off. We couldn't get to it. So it created an inflationary spike in commodities because of the oil embargo. That wasn't a function of economic growth. So we don't want that. That's bad, right? That type of inflationary spike is bad. What you do want is inflationary pressure in the economy, 2.5%, 3% growth in inflation. That's a very healthy thing. You want those to be growing along with the rate of economic growth. So don't confuse inflation as a bad thing. You want inflation. It's good for you. What you don't want is a spike in inflation caused by some event that is now impacting both producers and consumers simultaneously because of a lack of access to some product, service, or good. So, again, this is the big confusion. Everybody talks about inflation, but they really don't understand inflation. And yes, we conflate that with higher prices at the stores. Like, oh my gosh, I'm paying more. Yes, but your wages should have been going up too. And we are seeing wage growth in the economy. So when is this? We'll wrap up with this one. When is marriage a good investment? And when is it not? Marriage is a terrible investment if you marry the wrong person. I think so. I made this. So full disclosure, I'm divorced. Married. I'm currently on the second marriage with my wife. Yes, correct, Brent. I am on my last marriage with my wife. What went wrong in my first marriage? I married this very beautiful girl, fantastic, terrible partner, right? Just nothing wrong with her, right, at all. But just not a good financial partner. And what happens too often in marriage is that we fall in love with somebody, we meet them, we fall in love with them. We have this whole cathexis thing going on right now. It's the pitter patter of the heart. It's the lust. It's all those type of things. And so we start we overlook all of the red flags, right? And this goes both ways, mind you. This isn't just guy to girl, or this is girl to guy too. So, I mean, when this applies to both parties. When you're with your mate, and I spend a lot of time with my kids talking about this, particularly my daughters. I spend a lot of time with my daughters talking about this, is that there are certain things that you should want in a mate that has nothing to do with how they look, how they smell, those type of things, right? Are they going to be a good financial partner? Do they have the same values around money and credit? If they don't, I would avoid them, because that is only there's two big reasons why people get divorced. It is infidelity and finances. Infidelity is number one, finances are number two. But guaranteed, if you're having a lot of financial trouble in your household, you're arguing, you're fighting, you're not sleeping together, those type of things, there's going to be infidelity. So people dismiss and they overlook all the red flags about marriage when we're in the heat of the moment. Oh, she's so pretty, he's so handsome, can't wait to be married, it's going to be great, we're going to have this beautiful house. If the views are skewed, the marriage is not going to work. If he's a spender and she's a saver, it's not going to work. If he's frugal and she's not, it's not going to work, because you're constantly going to be battling over the finances, which is eventually going to lead to infidelity, which is eventually going to lead to divorce. But if you talk to anybody who's been married for a very long time, you'll find out that it's not about the love, the sex, those type of things. It's about their best friends, and they only want to spend time with each other, no one else. And more importantly, they're on the same page when it comes to their financial agreements. They talk about purchases they're going to make. They don't go buy stuff and hide it in the trunk of their car, that type of thing. You can tell I'm talking from personal experience. But those are the things that I have found the hard way, that's most important about making marriage work. So is marriage, the bottom line is this: is marriage a good investment? Absolutely. It is the best thing you can do with the right person. It is the worst thing you can do with the wrong person. You'll be miserable. So, and again, the right person doesn't mean how they look, how they smell, anything like that. It's, do they have the same values as you do? Are you best friends? Are you able to work through good times and bad times together? And look, this goes down to even simple stuff like, do they pick up after themselves around the house? You're a neat freak and they're not. That is not going to work. Ultimately, it's going to drive you crazy, right? So those are the things. But yes, marriage is a wonderful investment. You should absolutely invest in it. And plus, we need you to, because we have a declining birth rate. So you need to go have babies. We got to increase the demographics, but we need to do it the right way. So, all right, that wraps up the show for the day. Thank y'all so much for so many good questions today. We'll do this again soon, since I can actually figure out now that y'all can stay on topic for a show. This is awesome in the chat. Make sure and like and subscribe to the channel. We appreciate it very much. And like I said, this was fun. Definitely do this again in the future. So anyway, thank you very much for that. Be sure and get by the website, realinvestmentadvice.com. Our daily market commentaries out. Make sure and get your tickets for the upcoming investment summit, January the 17th. You don't want to miss out. AI, crypto, investing, bonds, the economy, financial planning from Ed Slott, America's Financial Planner. Lots of great stuff coming up on that seminar, on that summit, but get your tickets today. All right, have a great day. See you back here tomorrow.